Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we often start off our shows by talking about the big picture, and today you want to talk about the really big picture. You've got a chart of the S&P 500 that you pulled together going back, 20-odd years, to talk about whether or not we have met the end of the bull market or are in the throes of the end of the bull market.
That's right. This is a very, very big picture chart. It goes back to 1997. When I was in matric, so a long time ago. And it basically covers about 18 years worth of trading history. And the reason I've gone back that far is because quite clearly you can see on the chart there what it covers is three bull markets and two bear markets. And if we actually look at them, you can see now there's the bull market from sort of the mid-90s up until the dot-com bubble burst in 2000. You can see that one indicated there. And the trend line that demarcated that bull market was broken to the downside. What's interesting, and I'm going to talk about it more with this chart, but what is interesting is to notice how you get the major crack, the big breakdown below the rising trend of the bull market. Then you get this huge throwback. And this light blue line over here, that's a 50-week moving average. Okay. So it's a very long-term moving average, 50 weeks worth of data, because this is a weekly chart, by the way.
Okay.
But it's very interesting to note how you get that throwback up to the underside of the 50-week moving average, and then you get another leg to the downside, and then so goes your bear market after that. And then we had the bear market that ran from 2000 to the middle of 2002, early 2003. Then after that, we had another lovely bull market from 2003 all the way up until the end of 2007. And then, of course, we had the financial crisis and the bear market that ensued after that, which was very violent. But again, you saw the same characteristic. You saw the market breaking this bull market uptrend quite sharply. Then you get this sharp throwback to the underside of the 50-week moving average, and then a lower high, and the market continues to then fall from there.
And I suppose that sort of suckers in a lot of traders, doesn't it? When you get this kind of move back up to that 50-week moving average.
I think it could be, but I think what also tends to happen at that stage is by then you've got this technical damage that's been done. And of course, the sentiment has shifted in the market. You get that big, that rally, which could be sparked by some late buyers, I guess, or some short covering potentially. But the bottom line is you get that rally, but the rally is not strong enough to go and test the prior highs. And the reason for that is because as the market rallies, a lot of the market participants who thought, well, I missed the opportunity to sell the last time the market was this high, let me make sure I get out now, and they start to sell, and that's why you get that lower high. Now, what's interesting is that we're seeing a similar sort of scenario unfolding on the S&P 500 now. If you have a look, we've got that uptrend which goes back to the beginning of 2009, and it joins all the low points on the S&P 500 throughout this bull market over the last 6 years. And what's happened now is, look, we've broken convincingly below this long-term uptrend. And it looks as if the same pattern of trading action were to play out as what we've seen at the start of the prior two bear markets, then what we should have now is quite a sharp rally to go and test the underside of the 50-week moving average. And that comes in at around about 2,050 on the S&P 500. So what I'm saying is that I suspect we may well have started the next bear market here. But in order to be sure of that, we need to see what happens next. This market will most likely stage a bounce from here, a nice oversold bounce. But if we start to fail at the underneath of that 50-week moving average and turn lower from there, then I think there's a very real possibility that we've actually started a new bear market. And if that is the case, well, then where do we potentially go?
Yeah.
Well, looking at this, those prior tops from the peaks of the previous two bull markets came in at 1550. When we broke out through that resistance in about 2012, that was quite a bullish move. But there's no saying that we couldn't go back and retest that level if we do go into another bear market now. And that would mean that this S&P 500 would have pulled back 30% from the high. Okay. Keep in mind it peaked at about 21.30 recently. If it pulled back to 15.50, that would then be a 30% pullback in the market.
And I suppose what is quite, well, two things. What is quite concerning about that chart is it shows just how much more dramatic the last bull market has been.
Yeah.
So it's a much steeper progression, and it's also been longer. So, you know, it would be timeless to have a bit of a bear market now, because you've had 6 years of a strong market.
Absolutely. We've had a very strong market. We've had 6 years into the 7th year of it now. And if you look at the time frames of these bull markets, I mean, you can see that the bull markets obviously climb a lot more slowly and steadily. The bear markets are very sharp and dramatic. But this bull market is very, very mature. And there's been a lot of things happening. We've obviously talked about China and what's happened there and the slowdown in China. And big questions around whether the quantitative easing in the US has even worked. Now the stock market's come off the drugs and suddenly it's falling in a heap. So there's all sorts of things out there that the rhetoric is definitely shifting, I think. And it's not this same buy the dips mentality that we've seen so many times on previous pullbacks during this bull market. This time around, it really does feel quite different. It actually feels like this time might well be the end of the bull market.
Yeah, well, but it's not the end of everything, because as we've seen, it does come back again.
Sure.
Gus, so in the light of that, what does the top 40 index, which is of course what you generally trade, look like?
Yeah, so bringing it home, of course, now we've got a weekly chart of the top 40 over here. And this was also the whole bull market that we've seen since the beginning of 2009. And what's interesting is that trend line there joins all the low points that we saw during this bull market. And each time the market pulled back to that uptrend, you can see that it was quite well supported. The buyers stepped in and they took the market higher. Now we've broken convincingly below that upward trend. And we've kind of come down to this 41,500 area where there is a little bit of lateral support. It looks as if we're bouncing now. And again, like the S&P500, it's probably due a bit of a throwback to the underside of that, what was that uptrend. Now becomes resistance if the market bounces up to that area. And that would come in at around about 45,000 to 46,000. That sort of area is where you would potentially find a little bit of resistance here. So again, I think it's very key to see what happens next on this market. If we go up there and we fail and we reverse and we turn lower, then I think there's even more substance to the suggestion that this bull market is actually over.
Okay, so that's a big picture to concern ourselves with. In the light of the option structure that you put onto the portfolio or traded now more than a few weeks ago, futures closeout is next week.
Yes.
How's this looking? And in the light of, okay, maybe the bigger picture doesn't play out in the next week or so, what do you think is going to happen?
Well, that's it. Obviously, the bigger picture looking longer term. We've got 7 trading days left until this option structure expires. The futures closeout is on the 17th of September. That's next week, Thursday. And where do we stand now? Well, we've been nicely in this profitable zone recently. Where we are right now, well, the market's been trading at about 44,100 today. So what it means is that we're on the cusp of our maximum profitable zone. But if my thesis of the market staging a bounce from here to go and sort of to have a test of the underside of that 50-week moving average, if that comes true, well then, of course, from here, if the market bounces, we start to see the profits on this option structure begin to erode.
Yeah.
So I would be very disappointed if we got to the futures closeout next week and it was sort of up here at about 45,500 or just above, and we end up making nothing. So, in order to mitigate that, I have actually gone long against the structure today, and I've done it with the IG markets R2 per point micro CFD.
Which we traded a couple of weeks ago. We
did. We traded it successfully a couple of weeks ago, and we're trading it again now. We're going long. So what this CFD is a CFD that represents R2 per point. So with the index being at 44,100 now, what that means is that one contract effectively buys you exposure of about 88,000 Rand odd. We're doing 2 of those.
Okay.
So we're buying 170-something thousand Rands worth of exposure to the top 40. What that means is that if the market goes up from here, then that CFD will make us some money. And of course, at the same time, we're going to be eroding some of the profits that we've got on this option structure. However, if the market were to fall, then our option structure will make money for us. What I'm doing differently this time, however, is I am treating this top 40 long trade as an independent trade. It has a stop loss. You can see it on the screen there, 43,250. If it goes there and it goes below, then I'll close this long trade out and we'd lose 3,500 rand, which is about 1% of our capital. So I'm not going to cry myself to sleep about that. And then the option structure would take over, would be profitable. So it kind of covers us on both sides. And keeping in mind that we've only got 7 trading days left until the futures close out, I feel I'm relatively content doing this now. It's not like we're doing it with weeks and weeks and weeks to go until the closeout.
Yeah, and also not linking the two structures against each other, which was maybe the mistake that you made last year.
Certainly,
which caused you some sleepless nights.
Absolutely. October last year wasn't much fun for me. I had a few hairy nights there where...
well, you were in fact sobbing yourself to sleep.
Just about was, yeah, because we did that. We bought against the structure and then it actually fell into that danger zone on the left-hand side and it became a bit nasty for a while. Fortunately, we got out nice and alive. But the lesson was well learned that time.
Goss, so do you have that trade in a little bit more detail?
No, not more. This is it as you see it. That's the payoff as it sits now.
Okay, so a long option that you've taken heading into futures closeout. I know the one share you also wanted to isolate this week is SAB Miller as a potential short, which is quite interesting because, of course, SAB Miller is a rand hedge stock, and the rand is weak as it is. That's quite a curious, I suppose, strong stock to trade against. Yeah.
The interesting thing about SAB Miller is that everyone thinks it's a rand hedge stock, and to a certain extent it is because it's got its primary listing in London, and whatever the share price does in London, we need to make parity here in South Africa. So it is affected by the exchange rate from that perspective. But SAB Miller is actually also a negative rand hedge. And the reason I say that is because it's a company that operates in a lot of emerging markets. South Africa is a big market, but then there are all sorts of other emerging markets around the world where SAB Miller operates. And what that means is that we're currently in an environment where all emerging market currencies are very weak. So whatever SAB Miller sells in its various markets that it operates in, when it reports those numbers back into pounds, the numbers are actually quite disappointing. Yeah. So in that sense, SAB Miller is a bit of a reverse rand hedge as well as a conventional rand hedge. So from that perspective, I'm not too bothered about it, and I'm not too bothered in the sense that I'm looking at the potential for a short here. If I look at why we want to potentially short this stock, well, what's interesting is that the share price has broken below this uptrend, which goes back to early 2014. It actually goes back further than that. But you can see quite convincingly that share price has broken down there. We were trading in a band between 630 Rand and 680 Rand for most of this year. And we've also broken to the downside of that band. And strictly speaking, that if you take that move, you now actually project the height of that band and you project it down to get your target. And it takes you down to about 570, 580 Rand, that sort of area. So I think that's potentially where SAB Miller could go if it has another leg to the downside, which I suspect it will. And what I'm going to be looking out for here, because we haven't done the trade yet, but we're going to certainly watch this in the week ahead. Look out for a potential for a reversal down from that area around 640, 650 Rand. If we get a convincing reversal from there, then I think that sets up the short, which could then begin the next leg to the downside. So that's certainly what I'm going to be watching out for in the week or the next 2 weeks maybe as a possible trade for us.
Yeah, I mean, it would be interesting if SAB Miller's emerging markets exposure, which of course was something for which it was lauded over the last few years, suddenly swings against it and quite significantly so. Guys, then taking all this into account, what's the portfolio looking like?
So it's looking good. So similar sort of levels to last week. We're still up 43% for the year. We've got 357,000 Rand in the account. Those are a couple of the recent trades that we've done. There's our option structure, which we've got 1 week to go on. The Pioneer Foods and Zeda Pears trade, well, the less said about that, the better. Unfortunately, I got stopped out at exactly the wrong time, as I suspected might be the case last week. Anyway, we live and learn, and we soldier on. And then we did a trade on the IG Top 40 CFD recently, and now we've done another one this week where we long at 44,120. So those are the recent trades. It's looking quite good, and I'm quite comfortable with where we're positioned at the moment.
Yeah, it'll be very interesting to see what happens in the next 7 trading days. Garth, thanks as always for joining us. We'll be back next week, Tuesday. That was Traders Corner, and Garth McKenzie, of course, the founder and editor of Traders Corner.
Traders Corner was proudly brought to you by IG. Visit igmarkets.co.za to open a trading account today.